So guys, we are back with another round of portfolio reviews, and I'll tell you what, I am so excited to get into it today. We've got a few really interesting portfolios on deck, and we are going to go under the hood to take a look at each one. We'll check out all the holdings, and I'll give you my honest thoughts on what I like about these portfolios, as well as what I think could be improved. And as we're going through these, guys, keep in mind that I am by no means a professional. These are just my very amateur opinions, so definitely take them with a grain of salt. And remember that at the end of the day, this is all just for fun. Now, real quick before we get into it, if you want to have your portfolio reviewed by me in one of these videos, just fill out the form I have linked in the description. And also, as we're going through these, leave me a comment below and let me know what you think about these portfolios as well. I'd be very curious to get your feedback on them. Alright guys, so the first portfolio of the day here belongs to my friend Mason, who's pretty new to the investing game. Mason's been investing for less than 1 year and has some very lofty goals to live off dividends sometime in the next 5 to 10 years. And with that, Mason is investing somewhere between $100 to $200 every single month. Now, in the notes here, Mason says, I'm 13 years old. I also see lots of videos about dividend investing, and I'm trying to start now so the snowball effect kicks in sooner. So first and foremost, Mason, I think it is so cool that you are starting to invest at such a young age. Getting going with this stuff at the age that you're at is going to be a life-changing decision. So great job, my friend. Now, with that said, I don't want to take the wind out of your sails, but I want you to know that it is definitely going to take longer than 5 to 10 years to live off of your dividend income, especially if you're investing, somewhere between $100 to $200 per month, which is fantastic. I just want you to know that it's going to take likely at least a couple of decades, probably at least 20 years, maybe more, which is fine. The great thing about starting to invest at your age is that you have so much time to let this thing grow and compound. It's kind of like you said in your notes there, you're starting young so you can give the snowball effect time to do its thing. At any rate, getting into Mason's portfolio, he shared it with us over here on Blossom, which if you're an investor and you're not on Blossom, you definitely should be. This is the social media platform specifically for investors. And you'll get to see a lot of good stuff from some of your favorite people. We've got Ari there, we've got Mike the Dividend Guy, we've got dividend earners on here, the one and only PPC Ian, and everyone over here is sharing their portfolios as well. On Blossom, you can see my entire portfolio, and you can also stay up to date with all of my buys as they occur in real time. So you should definitely get on Blossom. It is totally free to join. There's a link to it in the description of the video and in the pinned comment. And I would be remiss if I didn't mention that they just rolled out this desktop platform right here. Prior to this, it was just the mobile app, which I've shown so many different times in my videos. You guys have seen that before. But I love being able to use Blossom here on the computer, so I'm really happy to finally have this. And they did a great job too. It's been really awesome to use. At any rate, guys, getting into Mason's portfolio here, as we can see, there are 17 different holdings, 2 of which are stocks. Here we have Stag Industrial and we have Realty Income, which means that the rest of the holdings in this portfolio are ETFs. That's right, guys. There are 15 different ETFs in this portfolio. And looking at the full breakdown, here are all of the holdings. We've got Stag here, which makes up 35% of the account. We've got Realty Income making up 19%, which means that the other 15 ETFs currently make up, what is that, about 46% of the entire portfolio. So kind of an interesting structure here in the portfolio, I would say. I'm not entirely sure how I feel about, Stag being a third of the portfolio, Realty Income being, near 20%, basically 2 real estate investment trusts making up over 50% of the portfolio. I don't know. But I will say, just kind of zooming out, looking at all of the holdings, I do think there are some good holdings here. I do like Stag. I like VIG here. This is a great ETF. I like Realty Income. Obviously, I like SCHD. And scrolling down, I like that there is the S&P 500 here as well through IVV, which is not like a huge percentage of the portfolio at all. It only makes up 1.2%, which brings me to what I think could be improved about this portfolio. This is not going to come as a surprise to any of you guys watching, but I think this is just way too busy. I think there are way too many ETFs in here, and all of these ETFs, or most of these ETFs actually, make up, less than 2% of the portfolio, from FIGB all the way down to IJR here, which actually, according to Blossom, isn't even 0.1% here in the portfolio. There's just way too much going on here, and there's bound to be some overlap between all of these different ETFs too. And when it comes to having ETFs in your portfolio, the thing to keep in mind is that each ETF is already going to have built-in diversification. Most of these ETFs already have over 100 different holdings just within one fund. And so with that said, with that built-in diversification, you don't need to have, over a dozen different ETFs in your portfolio. You can really get by with just a very small selection. And to put a number on it, I really don't think you need to have more than 2, maybe 3 max different ETFs in your portfolio. I think it's great to have an S&P 500 fund. That's a staple for sure. I think it's great to have some sort of dividend-focused fund. That could be either SCHD or VIG. I don't even think you need both. I think just one will suffice. And then maybe, possibly for a third one, maybe like an international ETF. And it looks like there are a couple here. We have FDEV, and we have, it looks like IDEV here as well. But other than those 3, which I don't think you would need anything more than that, other than those 3, I think you could get rid of the rest of these ETFs, especially considering most of them are such small positions in your portfolio. And also, at your stage in the game, just getting started, 13 years old, I would make ETFs the great majority of your portfolio, if not the entirety of your portfolio. Like, I would definitely make IVV a huge portion of your portfolio, SCHD a big portion of your portfolio. And if you want to have an international ETF as well, then same thing. But generally speaking, I would look to make ETFs maybe like 80%, maybe even more, but 80% of your portfolio. And then if you're feeling froggy, if you want to try your hand with some individual companies, maybe save the remaining 10 to 20% to do that. But I would make ETFs the great bulk of what you've got going on here. With that said though, Mason, you could be doing a lot worse, my friend. Like I was saying earlier, just the fact that you're even thinking about this stuff and even starting to invest at your age is such a huge win. And I have no doubts that someday you will be a very wealthy individual if you just stay on this path. So keep up the great work, and thank you for letting me review your portfolio. All right, guys, now getting into our second portfolio of the day. This one belongs to my friend Eli, who's also very new to this investing stuff. He's been investing for less than 1 year and has a bit of a longer time horizon, hoping to live off dividends sometime in the next decade or 2. And Eli's doing pretty well with those contributions. He's contributing about $1,000 every month. And in the notes here, Eli asks, do I have too many ETFs? Am I missing the growth while chasing the dividends? Thanks for your time. And just looking at an overview here of Eli's portfolio, he shared it with us using Snowball Analytics, which is hands down one of my favorite portfolio trackers. It's actually my favorite portfolio tracker. If you guys are looking for something with the most amount of bells and whistles, definitely use Snowball Analytics. It's got everything you need and then some. And the great thing is that you can try it out for free. In the description and also in the pinned comment, there's a link to try Snowball Analytics with a 14-day trial. I think you guys would really like this platform, and I highly recommend you check it out. But anyway, back to Eli's portfolio. At this time, it's valued at $11,300, and it looks like overall he's up a little bit, up 4.6%, which is not too shabby. Been looking at the dividend stats. Okay, so we've got a very, very high starting yield here at 11.2%. which is wild. And the dividend growth, there's really not much to speak of across this entire portfolio. At least according to Snowball, the average dividend growth rate is about 1%, not even 1% here. And I will say, for someone who is just getting started with investing and has, a decent amount of time before they plan to live off their dividends, I would like to see a better balance between dividend yield and dividend growth. And I think this portfolio, without even looking at the holdings, I already think this portfolio could stand to benefit from holdings that give a little bit more emphasis to dividend growth or even just growth in general. But anyway, scrolling down just a little bit, looking at the diversification breakdown, here we can see there are, looks like 11 holdings in total, 7 of which are ETFs, and the ETFs make up 76.5% of the portfolio, which I think is great. I would have liked to see, in Mason's portfolio, I would have liked to see the ETFs make up a higher weighting, kind of like what we're seeing here. So that all looks good. And scrolling down, actually looking at the holdings, I do see a few here that I like. I think JEPQ is fine. I think SCHD, obviously I like that one. Main Street Capital Corporation, I personally own. Realty Income, I own as well. But beyond these guys, I don't know. I feel like the rest of these holdings I could really do without. You already know how I feel about the Yield Max ETFs. You know how I feel about the Roundhill ETFs. It's, I'm going to lump them all into the same category. I'm not a fan of those whatsoever. And I'm especially not a fan of these types of ETFs for someone who not only has been investing for less than 1 year, but also someone who has a long period of time until they're hoping to live off their dividends. These ETFs, the round hills and the yield max and the like, they're just way too complex. And they're not time tested at all. I just think they're really risky things to put your money into, especially if you're someone who's just getting started with all of this. But generally speaking, when I look at this portfolio, I can't help but think it's a bit all over the place. And like I was saying earlier, even without looking at the holdings, there's just too much emphasis on these high yield investments. Even holdings like JEPQ and Main Street Capital Corporation and Realty Income, all of which I like, I just think you have too much time on your side to go this heavy into high yield investments, and you have too much time on your side to ignore dividend growth and also growth in general. With that said, and this probably isn't going to be much of a surprise at all, but with that said, I think there's a lot of room to consolidate in this portfolio. You know, you can keep JEPQ, you can keep SCHD. I think those are fine. And I think that these ETFs have slightly different things to offer. This will give you that dividend growth exposure. This will give you that high yield exposure. But I would replace the rest of this stuff, possibly even including Main Street Capital Corporation and a Realty Income, but I would replace the rest of this stuff with something a bit growthier, something maybe more like an S&P 500 ETF. I think that'd be a good option, or maybe even something like SCHG, which is pure growth. I think that would complement these other two holdings really well, and that's going to give you the best of all worlds. You've got your foundational, you've got your growth, you've got your dividend growth, and you've got your high yield. What more could you want? At any rate, Eli, you're off to a great start, my friend. Definitely be careful, please, with these yield max funds, with these round hill funds. They are traps, in my opinion. I don't trust them whatsoever. But like I said, you're off to a great start. Keep up the good work, and thank you so much for letting me review your portfolio. All right, my friends, now moving on to portfolio number 3. This one belongs to my friend Ez, who, like the first two fellas, has been investing for less than 1 year. And Ez has the longest time horizon out of the bunch, hoping to live off dividends sometime in the next 2 to 3 decades. And every single month, Ez says his goal is to invest at least $1,500. Now, in the notes here, Ez says, I work for LAD, which is Lithium Motors, and I'm enrolled in an employer stock purchase plan. I don't know if I am biased because I work there, but I do believe in the company being a great dividend growth stock. I do have a Roth that I have maxed out for the past 3 years, but this portfolio I started in mid-March of 2024. I'm totally new to investing, and I feel like I've made a bunch of errors already. One was not knowing about the ex-dividend date. I bought a lot of Vici for the dividend, but since I bought it after the ex-dividend date, I didn't get anything, and then the price of it went lower. I felt really mad because I could have got it way cheaper. So a couple of things here. As first and foremost, great job taking advantage of your employer's stock purchase plan. I think if you believe in the company and think it's a great company to own, then why not take advantage of something like that? I think that's awesome. Plus, having some skin in the game where you work and actually being an owner of the company is only going to create some really positive incentives that's probably going to make you care more about your job. It's going to help you do your job better, and that's only going to serve to benefit your career there. So I think that's great. Now, as it pertains to the ex-dividend date, seriously, do not sweat that at all in the grand scheme of things. If you miss, 1 quarter's dividend payments, it's certainly not going to be the end of the world, especially if you plan on being a long-term owner of VG properties, which you should. Like I said, missing out on 1 dividend payment, you're going to be just fine, I promise. So don't sweat it. At any rate, taking a look at Ez's portfolio, he shared it with us here using my dividend portfolio tracking spreadsheet, which you can start using for free. You can download this spreadsheet. There's a link to it in the description of the video and in the pinned comment. But Ez's portfolio is coming along pretty well. He's got about $85,000 in here. And looking at the dividend stats, I think these are very well-balanced stats. Very, classic dividend growth, a 2.7% starting yield and a 10.5% dividend growth rate. I love that. And every single year, Ez is bringing in about $2,300 in dividends, which breaks down to almost $200 every single month, only a few bucks away, that's awesome. Now, if we jump over here looking at the holdings, it looks like there are 13 holdings in total, 12 of which are individual companies, with the lone ETF here being SCHD, which if we scroll over, it looks like SCHD makes up 21.2% of the portfolio here. And I will say, I really don't have an issue with any of the holdings that I'm seeing here. These are all very solid stocks and ETFs, and it doesn't feel too over-diversified. 13 holdings. We've seen portfolios in the past that, have 30, 40, maybe even more individual companies. And I think this is a pretty solid setup. For the portfolio value, less than 100K, I think 12 stocks with one very diversified ETF. I think this is a pretty solid setup. Now, I will say, if I was being nitpicky here in this portfolio, the only thing that I think I might change, believe it or not, is I don't know that you would need to own Starbucks in this portfolio. It looks like you only have 1.5 shares. And if we scroll over, it only makes up, basically 0.1% of your portfolio. So it's not a huge weighting of yours at all. And so with that said, because it is such a small percentage of your portfolio, unless you planned on building out this position and buying more shares, I just don't think it makes sense to have something like this in your portfolio, considering how small of a position it is. And I guess you could potentially say the same thing about Booz Allen Hamilton here, which I think is a solid company. It only makes up 1.5% of your portfolio. Blue Owl Capital Corporation, same thing, only 1.7%. Unless you plan on adding more to these small positions, I just don't know that they're worth having in your portfolio. Otherwise though, I think you could be doing a lot worse, my friend. I think you've picked out a pretty solid batch of companies. Obviously, I love me some SAHD, so I think you could be doing a lot worse. So keep up the good work, and thank you for letting me review your portfolio. Anyway, guys, those were our 3 portfolios, and if you want to see inside my portfolio and see exactly how much money I've made with dividend investing, then check out this next video right over here. I've been investing for about 5 years now, and in this video, I'm breaking down the performance of my portfolio, along with all of the dividends I've received up until this point. So click right over here to check all that out, and I'll see you in the next one.